Growth Investing, a Tackle Trading Glossary video. The definition of growth investing. Growth investing is an investment strategy that is primarily focused on capital appreciation. Growth investors look to invest in paper assets that they have reason to believe will rise in value, most often in what are called growth stocks. Growth stocks are stocks issued by companies that exhibit above average economic growth. Example given here, companies whose earnings are expected to grow at an above average rate compared to the rest of their industry. Typically, growth investors are less concerned with the current stock's valuation, and they're more concerned with the potential future evaluations. In fact, among the most important factors are a longer-term trend of growth quarter over quarter, as well as strong fundamental growth expectations. The greater the growth potential, the better. Much like value investors, growth investors rely heavily on fundamental analysis to base their investment thesis or their investment decisions. Let's take a look at growth investing compared to value investing. Value investing is going to focus on the intrinsic value of the asset, the current price to earnings value, for example, and they're looking for a good deal. Whereas growth investing is less concerned with the current valuations, although they're not ignoring that. They're more interested in the potential growth value that those projected growth estimates would yield in the growth in the company, therefore growth in profits, therefore growth in the asset value. Timing for value investing is typically based off of the current value. They're trying to get it at a deal or at a discount, so they wait for prices to drop to buy, for example. Whereas growth investing, again, is more concerned with that future value, and the timing is less critical. Profit source for value investing, you want to pick a good, blue chip stock that pays dividends, for example. Nice quarterly gains and dividends. Whereas growth investing is looking for capital gains. They're looking for that price of the asset, the stock price, to rise tremendously in value. Again, value investing, they're looking for good companies that are undervalued, that their current price is less than the market value, whereas growth investors are going to be looking for fair to overvalued, fair stocks, fair value to be great, overvalued's fine as long as it has good growth potential. They tend to look for more for fair value with growth potential combined. The risks for value investing are, getting the value assessment wrong. Finding a value trap, which is a good way to get caught in buying an asset that ends up not maintaining its value. Whereas the growth investor has high uncertainty, and they could potentially wrongly project those earnings, and they might be buying an asset at an inflated price. So that is a good example of a comparison between value investing and growth investing. If you enjoyed this video, come hang out with us over at tackletrading.com, where you can learn, trade, connect, and succeed. Visit bit.ly/join-tackle pro and come check it out. We got a 15-day free trial you can take advantage of.